Hello, my name is Jack Helder, Senior Director for Advanced Planning with Comprehensive Brokerage Services. Today we're going to continue our conversation about premium financing done the right way. This is the second in a two-part series. In the first part, I covered premium financing in general, the client profile, the transaction itself, and how it works. In this part of the series, I'm going to cover what makes us different, how do you do premium financing the right way? So let's get into it. First thing to understand is that here at Comprehensive Brokerage Services, we are planners first and foremost. There are a lot of shops out there that view premium financing as the end in itself. They're, these one-trick ponies you see out there. That's not us. We view premium financing as a means to an end, not the goal in and of itself. That doesn't mean we're not veterans and seasoned veterans at that. We have almost 20 years of experience. We do more than 20 cases a year, all premium financing. And our reality is that we turn away more cases than we accept because we want to protect our persistency. Our persistency is good for our clients because we regularly get exceptions from lenders and carriers for our advisors' clients. And it's good for us because we're in it for the long haul on the administration side. And if you don't have the right client who doesn't have the right risk profile, premium financing doesn't make sense. So the way we protect our persistency and set the stage is through an exhaustive front-end process combined with professional back-end administration. So I'm going to talk about those two components of how we do premium financing the right way. There are lots of pros and cons to premium financing. The pros are easy. You have a nice size premium, your client's paying less than the entire premium, and that leads to a really nice internal rate of return. It's a great idea for clients who are facing illiquidity, but they need insurance. It's a great plan for clients that have used or have earmarked their lifetime exemption. It minimizes their contribution to the insurance, so it helps alleviate that gift tax pressure. There's a lot of great uses for premium financing, and those are the spots where we use it. But with those benefits come some risks. These are long-term transactions, and you can't control the future borrowing costs. If you're into a transaction for 10, 12, 20 years, you don't know what interest rates are going to be in the future, and you don't know how the policy is going to perform in the future. So what does that mean? It means the client could potentially face negative arbitrage, times when the cost of capital increases faster than the crediting on the policy. And what happens then? Well, it will cause the client to increase their collateral requirement. It could cause the rollout, the forecasted rollout, to be later than expected. It could require more premiums than are expected. It could require the client to increase their out-of-pocket cost unexpectedly, and it could require you to make the decision to reduce the death benefit so that it reduces the internal charges so that the policy has less of a COI drag and performs better. The key here is making sure the client understands these are potential outcomes. So we illustrate each of these potential outcomes and put it in front of the client to make sure they understand, so that they understand that this is not a set it and forget it. This is a long-term commitment that requires attention and ongoing administration. And you can mitigate these potential outcomes with ongoing administration. And that's the second thing I want to talk about. And that is what we do once a case is put in force. So professional administration, premium financing administration, includes multiple components. It takes about 75 days front to end per case each year. And it entails what we call lender management, which is, but first understand, premium finance loans are based on a have a spread over an indexed, and they can be negotiated. There's wiggle room, and there's lots of lenders competing for business. So each year, we renegotiate terms with the current lender. We shop those terms with the client profile to the market to see if there's better financing available. If there is, we go back, put pressure on the current lender to match better terms. They often do, but not always. In the cases where they don't, we might recommend to the client they refinance with another lender, which can be an exhaustive process, and we set the expectation about that. So we shop the lender every year. We assist with the collateral administration. What that means is that if the policy underperforms, the collateral requirement goes up. If the policy overperforms, the collateral requirement drops. We work with figuring out in advance what the collateral requirement is going to be for the subsequent payment, for the next loan from the lender. And sometimes we use bridge loans if the collateral requirement is going to go up because there's a gap between when the lender is ready to fund the next premium payment and when the life insurance company credits the policy. So timing is key in collateral administration, but we help forecast the amount of collateral on an annual basis and select, make recommendations on selecting the best assets when you have to use outside collateral. Finally, we're looking at policy performance in a variety of outcomes. And that includes looking at the client's health profile in field underwriting to make sure that that the insurance that they purchased, that they financed, is still meeting their objectives and goals. It requires lots of in-force illustrations, both before and after each new loan. We take an exhaustive approach. And like I said, it takes 75 days each year per premium finance case we put on the books. Let me illustrate the benefit to you and a client of our administration approach with a case study. Meet the Dr. and Mrs. Green, male, 51. We underwrote them, came in table 4, but the agent had already laid out the benefits of premium financing, and he was very intrigued. We worked with the life insurance companies to move that table 4 to a standard. We designed the policy as a 10-pay, $10 million policy, annual premium just over $400,000 a year. At the time, it's 2007, the illustrated rate was 8.3%, and the loan rate was 5.1%. Both of those, in 2007 were competitive. I've said 2007 a few times because we all know what was about to happen. And unfortunately, the Great Recession struck, and the agent, in his case, disappeared, exited the business and stopped taking his calls. The policy returned 2 zeros in the first 2 policy years, which, as you know, from a sequence of returns perspective, poor returns in the beginning puts a ton of pressure long-term on an investment. Same thing happened in this case. And we were very glad that we set the expectations with the client and showed them this potential outcome. And what it meant is that with the agent disappearing, we stayed involved in the case. And it meant there was hundreds of phone calls and thousands of emails over the years. And they experienced, this Dr. and Mrs. Green, firsthand how we administer a policy. So every year we conduct field medical underwriting. Every year we comprehensively forecast various outcomes, shop lenders, and rates. In their case, in year 3, we ended up refinancing because we found better rates. The current lender wouldn't match. In year 7, we recommended that we reduce the death benefit so that we could lower the cost of insurance drag and get a little bit more performance, and we had to refinance again. Year 8, and now things are starting to look a little bit better because if you go back in time, this is the mid-2010s, policy's performing pretty well. We determined the policy would stay in force longer than Dr. Green's life expectancy without additional premiums in years 9 and 10. Remember, it was originally designed as a 10-pay. We ended up realizing we don't need to go all the way. We can 8 premium payments are going to get us where we need to go. The outside collateral requirement burned off in in year 9, meaning the cash value now exceeds the value of the loan. And then in year 12, the cash values were able to pay off the loan and keep the policy in force far, far beyond his life expectancy. Dr. and Mrs. Green became much more than clients. In fact, they became very good friends. And they even sent when at rollout, sent a Cartier watch to our premium finance director as a token of their appreciation. They got the best that Comprehensive Brokerage Services has to offer, but so do all of our clients. And if you have the right client, which is a client that is high net worth, illiquid, needs insurance, and they understand the use of leverage, whether that is an entrepreneur who's used, bank loans to enhance their business, or investors that use margin to increase their returns. If you have the right client, you need the right partner, and that's us. We understand that premium finance is a means to an end, not an end in itself. We make sure we do it the right way on the front end, and we're in it for the long haul, so you can trust that your clients are in good hands. If you have a client that makes sense for premium financing, we'd love to have that conversation with you. You see my contact information there. Please don't hesitate to reach out. And with that,